Dr. Neha Seth, working in the capacity of Associate Professor in the area of finance for Symbiosis Institute of Business Management, Noida, a constituent of Symbiosis International Deemed University, Pune. Today, I am here to discuss with you financial systems in India. The topics that we are going to cover today will be Introduction to Financial Systems, Functions of Financial Systems, Evolution of Indian Financial System, Components of Financial System, Regulators of Indian Financial System. So let us start today with the understanding of what is financial system. Basically, financial system is like a spider web where various financial components are knitted closely and contributing towards economic development. It is a platform where the lenders and the borrowers are coming together to fulfill needs of each other. Let us try to understand financial system with the help of an example. Suppose person A, who is a businessman, he needs some funds to start a business. These funds are known as capital for him. He is short of these funds. And there is a person B who is an employee in a public sector, who is a regular recipient of salary. He is consuming out of his salary, and there are funds which are surplus at the end of the month. Now he is thinking to invest this money to get some additional income from this hard-earned income. Now for this purpose, he wants to save this money. Where should he go? And from where the person A will get the money? So the platform to fulfill the need of these two persons will be met by the financial system. Now person B will go to bank and deposit his money to earn some extra return. Person A will go to the same bank and may ask for some debt. And he will get this debt in return of, say, some interest. In this way, they both get a platform. The needs of both of these persons will be fulfilled. Now, this person A, who is a businessman, he gets his capital. He will start his business. He will buy some land. He will build a building on it. He will start a factory. He will acquire assets like machinery. He will also hire some labor, some managers. He is going to pay some salary to them. And ultimately, these laborers, managers, they will also consume this money. And at the end of the month, if they are having surplus, they will again go to the bank and deposit their savings to the bank. And this is how this cycle works. This is how the system works. And this system is known as financial system. This is something that contributes to economic growth of any nation. So, the financial system is a set of institutions, markets, or instruments that promote savings by channelizing them to most efficient use. The financial system of an economy provides a way to exchange funds between the lenders and the borrowers. We can also say they helps us in exchanging the funds between the one who is having surplus of funds and the one who is having or who is going through short of funds. The efficient allocation of economic resources is achieved by a financial system. Financial system can also be said as a set of institutions, markets, instruments, and services to promote savings in an economy. It provides the platform for exchange of funds among lenders and borrowers. The financial system, or I must say the strong financial system, helps in achieving the efficient allocation of economic resources. There are definitions which are given by famous economists. One of the definitions which was given by Van Horn. So, in the words of Van Horn, the financial system allocates savings efficiently in an economy to ultimate users either for investment in real assets or for the purpose of consumption. There is another definition given by Prasanna Chandra for financial systems. Now, according to Prasanna Chandra, financial system consists of a variety of institutions, markets and instruments related in a systematic manner and provide a principal means by which savings are transformed into investments. Now, let us move on to functions of financial systems. There are multiple functions which are served by an efficient financial system, out of which the first one is saving functions. So, a financial system provides us the options of savings. They actually helps us in putting our surplus money to some better use so that we can earn some return out of it. This savings will ultimately contribute to economic growth. So, this is the way, or financial system I can say is the way that channelize the saving to the efficient use of economic resources. Another function which is served by financial system is liquidity function. So, if we are investing our money in financial assets and suddenly there is a need that arises for the cash, suppose. So, from where we can get the money? So, this financial system provides us with this liquidity function. We can easily go to the market and we can convert our financial assets conveniently into cash. So, this kind of liquidity function where our financial assets can be convertible into cash is provided by financial system of an economy. Financial system also serves as a payment function, serves us with the payment function, wherein the financial system is providing us the convenient modes for the payment. Earlier, we used to use checks. The time has changed when we have moved to debit cards and credit cards. And now we are experiencing the transformation through where we are making our payments through UPIs. We have wallets, e-wallets in our mobile phones. So, just by clicking on our mobile phone, we can easily make the payments. So, this kind of function, this kind of transformation that we are experiencing is because of the financial system that we are having. Financial system also serves us with the risk management function, or I can say the risk function, wherein this financial system provides us with a platform wherein the person can secure his assets, health by managing risk, by putting the money in insurance. So, this insurance sector or the facility of insurance is provided by a financial system wherein we can manage our risk through these risk management tools. There are other functions which are served by financial system as well, like reformatory system or reformatory function, wherein this financial system from time to time is coming with innovative tools or innovative investment options. At the same time, they are also providing us with information function, wherein the price about wherein the information about the price of a financial asset is also given by a financial system. So, these are the functions which are served by a financial system. Let us move ahead with the discussion about evolution of Indian financial system. So, Indian financial system has seen a drastic change in past so many years. There are three major phases of Indian financial system that we have witnessed. The first phase was pre-independence phase. The second phase was post-independence phase. The third one is post-1991 phase. Okay, let us see these phases one by one. So, when I talk about pre-independence phase, this phase lasted up to 1951. The structure of Indian financial system during pre-independence era was that of traditional economy. The main feature of financial system during pre-1951 was that of a closed economy that consists of semi-organized security markets, closed circle industrial entrepreneurship, restricted access to foreign savings, and absence of financial institutions in long-term industrial financing. Then we have this post-independence era, which lasted up to 1990. There has been a significant growth in the Indian financial system in terms of qualitative indicators as well as in diversification and innovations. This period was progressive transfer of its important constituents from private ownership to public ownership. An overview of the development of Indian financial system in post-independence period up to 1990s includes nationalization of banking and insurance sector. When we are talking about nationalization of banking sector, the transformation I've witnessed that the post-1951 phase was landmark era in the history of Indian financial system, with the nationalization of RBI and SBI in year 1949 and 1955 respectively. So the RBI was nationalized in year 1949 and SBI was nationalized in year 1955. Not just this, the insurance sector was also nationalized in this era. So in year 1969, another 14 major commercial banks were brought under direct control of Government of India. The nationalization of LIC that happened in year 1956 and GIC, that is General Insurance Company, it was nationalized in year 1972. These two were another historic measures that took place in this era. Another transformation that we have seen in this era was development banks and institutions that were introduced during this time. The government created a wide range of new institutions in public sector that may lead to development of Indian economy. The institutions were created to cater financial needs of industries and between them covered the whole range of industry. The public sector occupied a commanding position in the industrial financing system in India. When we have witnessed the transformation, the development of our economy, there arises the need of investors' protection as well. Now people are coming up with their saving. They are putting their hard-earned money to different uses, where this money is used for economic development. Now these investors, these savers, the lenders, they need protection. And for the purpose of investor protection, there are a number of acts that were introduced. So during this period, there were grossing mismanagement of the companies. There were increase in corporate frauds and abuses. There was loss of public confidence in corporates and security markets. Now to restore the investors' faith and confidence, the government adopted drastic measures and they have introduced number of acts. Few of the acts that were introduced during this time was the Companies Act 1956, the Capital Issue Act 1947, Securities Contracts Act 1956, Monopolies and Restrictive Trade Practices Act 1970, Foreign Exchange Regulation Act 1973, and many more. When this era ended, a new era came up. This is known as post-1991, that is post-new industrial policy era. This has introduced the major transformation in the financial system of our nation. We have profounded transformation in the Indian financial system during this era. The conservative philosophy of the development process that shifted to free market economy. There are a number of transformations that has happened during this time. Major reforms took place during this era. The first one was shift from public control to private ownership. The major steps initiated during this phase were to privatize important financial institutions. The conversion of IFCI into a public limited company happened during this time. IDBI offering their equity to private investors were all parts of privatization of financial institutions. The setting up of private mutual funds and banks under the guidance of RBI also came into existence during this time. Transformation of institutional structure has also happened during this post-1991 era. It became more capital market oriented. This is reflected in the changes in roles, organizational policies, term lending, commercial banking, mutual funds, and many more sectors. In August 1991, a high-level committee was appointed under the chairmanship of Mr. M. Narasimham, the former RBI governor, and this committee submitted report in November 1991 with some suggestions. These suggestions were related to privatization of financial institutions, reorganization of existing financial structure, protection of investors, capital adequacy of capital structure basically, review of supervisory arrangement, improved efficiency, effectiveness and competitiveness. So these were the transformations that were introduced during the new industrial policy era, that is the era that came after year 1991. From this, we will move ahead with Indian financial system and its pillars. There are 4 strong pillars of Indian financial system. The first one is financial institution and intermediaries. The financial institutions and intermediaries are classified into 2 categories. These are banks and non-banking financial institutions. The second pillar is financial instruments. These financial instruments are categorized as primary financial instruments, secondary financial instruments, and then we have risk management instruments that are known as derivative instruments. The third pillar of Indian financial system is financial markets. Financial markets are categorized as money market and capital market. Money market is a market for short-term investments, whereas capital markets is the market for long-term investments. This capital market is further classified into primary market and secondary market. So when the financial asset which is coming into the market for the first time, it is introduced in primary market, while the same asset, when it is traded further amongst the investors, then these investors are trading into secondary market. The fourth important pillar of Indian financial system is financial services. These financial services are categorized into fee-based services and fund-based services. So these are the 4 important pillars of Indian financial system which constitutes or which led an Indian economy towards growth, and which is making our Indian financial system is one of the strongest financial system in the world. So thank you for now.